Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Global stocks stabilise after a sell-off that wiped $1.6 trillion from global equities. We'll preview today's earnings from Nvidia for a health check on the AI boom. China reportedly suspends imports of Japanese seafood. Talks between the countries failed to ease tensions after comments made by Japan's new leader about Taiwan. Plus, the UK budget is 7 days away. We'll break Britain's latest inflation print in just a moment.
Well, we're starting this hour with S&P futures again in the red, but just slightly down 1/10%, adding to yesterday's losses on Wall Street, which has seen the S&P 500 decline for 4 straight days in a row, the longest streak since August. Eurostoxx 50 futures trading flat at the moment, but it was a weak handover again from Asia. The MSCI Asia Pacific also on a 4-day losing streak. The countdown to the opening trade starts right now.
Right off the bat, let's get to some breaking news coming out of the UK. The CPI numbers crossing the Bloomberg terminal as we speak. And right off the bat, I should say we are getting some market reaction, kind of mixed, I should say. And I'm pulling up these numbers on my Bloomberg terminal. I'm looking at some of the prices that are coming through. And I've got to say, just as I need the numbers, there you go. The CPI rising 3.4% year over year, right up bang on line with estimates. The consumer prices, though, not rising by the amount that it was expected. We were estimating 3.5%. They only rose 0.5% on a year-over-year basis.
Something strange in that number. Let's get back to the overall. I'm looking at the Waco screen, and on the Waco screen, I've got the CPI year-on-year at 3.6%, which is just a shade below. Well, it's less than where it was. It's a little above where the market had expected it to be. The core number looks to have dropped to exactly where was expected. Services dropping a little further than had been anticipated. So on the Waco screen, those all seem to make sense. Some of those headlines, that red headline didn't make as much sense. Maybe Valerie has some insights. But in terms of where we're expecting this to go, this does chime. The fact that we've seen a drop down in CPI, this does chime with the fact that we're supposed to be decelerating. Perhaps we've already seen the peak in the inflation story. It does seem as if the market a little confused by some of the data that we just got there, Valerie, as well. But I think if you go off the Waco screen, things seem to make a little bit more sense.
Well, look, it looks broadly in line. Maybe there is going to be some relief in the fact that services CPI came in slightly soft. Remember, we're hoping that this print would show that CPI in the UK would be on a downward hill from here and that we're past the peak, the recent peak of inflation. And we put this all into context with the recent data that we've gotten out of the UK. The labor market has continued to cool. Economic growth experiencing a slowdown. If we look at the GDP data of last week. So take this all together. I think this does pave the way for the Bank of England to look for that December cut. The market is pricing that in with an 80% probability and also looking for another cut sometime next year before April.
We still have quite a finely balanced decision, though, at the Bank of England, don't we? And we saw that on display with Pill and Dingra speaking in just the last 24 hours, giving quite opposing views of the inflation story. Pill suggesting that the inflation problem is not as big as the market, the headline number might make it look, and Dingra suggesting that there's quite a K-shaped consumer experience of the costs of living right now. So lots to talk about when it comes to that where the Bank of England goes. Is there room for another cut this year, or do they wait till next year? And of course, we have the budget. That's just next week.
We have the budget, and how much of what we're going to hear from the budget that comes next week is going to address some of the where the inflationary pressures are coming from. So food, from energy, to your point of the consumer experience is crucial, because at the end of the day, it's not necessarily the other parts of the economy that are driving the inflationary part higher. We're also still far away from that 2% that the BOE is still targeting in the long term. So we, of course, will see how that all shows up. But coming right back to the markets here, and we'll wait the gilts open in about just under an hour's time. Looking at 131 on the pound. And if you look at the tick-by-tick chart, which you can see on your screen right now, that looks like a confused market right off the bat. So
it does.
That's the UK story. Let's talk about the broader macro picture and arguably the tech story as well, Val.
Yeah, look, it's been a pretty horrible 5 sessions for the U.S. equity market. The S&P 500 is on a 4-day losing streak. It's lost around 3.5% in that time frame. We're now down around 6% from all-time highs if you're looking at the NASDAQ. So again, this retracement has continued this week. It may be upsetting for those equity market bulls that we haven't gotten on a firmer footing ahead of this key release from Nvidia out later today. We have just over 14 hours to wait for that release from Nvidia, but it does seem like the equity market has not been able to find a firmer footing headed into this release.
Yes, although maybe the fact that US futures are kind of flat, is that what we define as a firmer footing, given we just lost over $1 trillion in global stocks? I mean, relative to the last couple of days, maybe that looks a little bit firmer. But I take your point, Valerie. I mean, it's quite unusual that we get such a big move into the Nvidia numbers, isn't it? And there's clearly a lot on deck, a lot to prove. What are they going to say about data center revenues, about the Blackwell chip? Q4 and the guidance they give there will be really important. Although for the whole sector, a lot of the focus has been on the depreciation rate. Will they be able to add anything into that conversation, the rate at which the hyperscalers are depreciating these Nvidia chips? And that's not really Nvidia's decision, I would assume, but maybe they have some insights and intelligence to share with us on that front.
Yeah, there's the Nvidia piece of it, and it already feels like the markets are kind of bracing themselves for bad news, and we've seen that here for a little bit, to Valerie's point. There was also some news over the last 24 hours there that kind of circular action between the credit lending and the stakes that various big hyperscalers are having, various AI players, is actually only getting bigger. You have Anthropic starting to partner with Microsoft's technology. You have Microsoft investing in other pieces of technology. They're all doing it through a lending perspective.
It was interesting that didn't boost the market yesterday, did it?
As much as these previous deals.
Almost plays into the market's fears, doesn't it? Kind of like, stop doing deals, stop investing in each other, and let's everybody settle down for a moment.
Yeah, for the last two sessions, Nvidia has been the main drag on the NASDAQ for 2 days running. It was down near 3% yesterday, and so you have to wonder whether maybe the bar is being set lower for these results, given the shares have moved lower by around 4% in the last few sessions. So given that context, I am just looking at S&P futures flipping into the green. So perhaps, Anna, to your point, maybe we do find a firmer footing in today's session.
If that's what stability looks like these days. There we go.
These
we'll take that
later.
Kriti, should we talk geopolitics? Because I know you guys have been talking a lot over the last couple of days about China and Japan and the tensions there.
Yeah, exactly. Day 3 of these kind of escalating trade tensions. But although I was looking at some of the data, and Val, you and I have been covering this for the past 2 days as well, where we have been seeing this kind of tit-for-tat question, this economic relationship between China and Japan that's coming under some pressure off of comments that Prime Minister Sanae Takaichi had indeed spoken when it comes to Taiwan. You're already seeing Beijing try to kind of put them back in line. You're seeing Japan try to offer an olive branch. At the end of the day, though, when you look at the economic relationship, a lot of it is coming down to seafood imports. And this isn't something we talk about very much at 7 o'clock, but I think it's important because when we're talking about this broader landscape of trade kind of moving from different parts of the world into non-traditional parts of the world, China's already been pulling back on some of their seafood imports for about a better part of the year, for about 9 months now. So this is really just adding on to some of the tensions that are already showing up. The reason we care is because the market is actually trading on this. And we saw this in the last 2 sessions. We saw this in the Asian sessions there. We're seeing it in some of the stocks this morning.
Yeah, look, maybe seafood stocks or seafood imports isn't really the hot button issue to get Japan to apologize for these comments. But what China could do, and maybe could worry the market even more, is do something about rare earths, do something about semiconductor trade. That would be something that would really hamper the Japanese car industry, which employs around 10% of the workforce in Japan. So again, we're just keeping an eye on this situation because again, the new prime minister has really staken her claim on wanting to get GDP growth, a boost to Japanese growth. And this could be something that could really hamper her in her first month of being prime minister.
Right, yes. Although I was really interested in an opinion piece out of our colleagues in Japan this morning that seems to suggest that the Japanese view is that all of the inflammatory language is coming out of China and that this isn't necessarily taking the conversation in Japan any further than they would have expected it to go right now. So there's a different, I suppose there's a different take on it in Japan. And also Gareed Reedy of opinion saying that this might actually further the Prime Minister's ability to get her domestic agenda through if, you know, there's nothing like an enemy outside your country to bring your enemies domestically or your rivals domestically on board. So we'll certainly watch how these dynamics play out. Let's get back to where we started the programme, shall we, with that data out of the UK. We were right to cast a little bit of a sceptical eye over one of the CPI numbers that we had at the top of the hour because it was incorrect on the Bloomberg terminal. So we'll just correct it because I think the incorrect number probably automatically appeared at the bottom of the screen. The UK October CPI rising 3.6%. That was against an estimate of 3.5%. So it was 3.6%. It was not 0.5%. The market clearly didn't believe that number because I think it would have reacted a whole lot more if it really did. But it was confused So I'm glad we've now got the clarity, and the data on that Waco screen was correct, though. So thank goodness for that.
There we go. You certainly caught the thing that we needed. Let's tell you else what we got coming up on the show today, because a series of all of these topics that we're going to hit throughout the show as well, starting with the FX story. Kamakshya Trivedi, Global Sachs Chief FX and EM Strategist, is going to be joining the program alongside Steve Hare, the CEO of Sage, an AI conversation there off the back of some earnings numbers. We'll get to that shortly throughout the show as well. And then we go right back to the cross-asset conversation. Patrick Brenner over at Schroders, the CIO there, is going to be joining the program. And, of course, it is Nvidia Day. Happy Nvidia Day to everyone, if we haven't said that already. Richard Windsor, founder of Radio Free Mobile, is going to give us his take, not only the Nvidia story, but the broader tech story.
Well, let's take a look at the risk events on the horizon. We do have some European data today. We get the final reading from Euro area CPI at 10 a.m. UK time. Also, a lot of earnings to keep our eye on. Nvidia, as we mentioned, the big one after the bell. But before the bell, we do get Target earnings to continue the waft of retail earnings out from the U.S. At 7 p.m. UK time, the Fed minutes are released. Remember, that was a contentious decision. They did decide to cut rates, but there was a three-way vote split. It's very interesting to see if the minutes reveal any further discussion on where to for the December meeting and how these Fed officials were posturing themselves in that debate back in October. We're also monitoring Zelensky's movements. He is headed to Turkey today.
Certainly something we're going to watch in the context of some of the grain conversations. There is a market component there. It gets a little niche, but certainly one that we want to keep an eye on. Let's get to what else you need to know this morning. SAP says it will maintain access to Microsoft's cloud services, even if a foreign government attempts to cut it off. This comes after Donald Trump's administration sanctioned it in an international court in The Hague. The two companies signed, of course, an agreement to, quote, safeguard business continuity in Europe in times of crisis. Under the pact, SAP said it will keep Microsoft services running for government clients of its new product, Delos Cloud, in emergency situations, including government sanctions. We heard some of those emergency situations, the Cloudflare story yesterday. We'll dive into that throughout the show as well. The U.S. Senate, in the meantime, moving to clear a House-passed bill forcing the Justice Department to release its Jeffrey Epstein files. The House approved the measure 427-1, signaling strong bipartisan support despite President Trump's earlier opposition. The President of the United States has since relented, though he could still delay the release of some documents as he orders new investigations into Epstein ties to Democrats. And sticking with the White House, U.S. President Donald Trump says Saudi Arabia's Crown Prince Mohammed bin Salman knew nothing about the murder of Washington Post columnist Jamal Khashoggi. He made the comments as they met at the White House to announce a deepening of economic ties. Trump also designated Saudi Arabia as a, quote, major non-NATO ally. This is all while the two countries signed a loosely worded defense cooperation pact, with the Saudis promising to invest in the United States.
For the Crown Prince, Your Royal Highness, you're talking about $1 trillion of investment. Could the kingdom continue to do that with oil prices in the mid-60s?
We're going to spend in the short term around $50 billion by consuming those semiconductors for our needs in Saudi Arabia. And with the agreement that we're going to have with South America, that will allow us to focus that consuming power.
A really fascinating conversation that we're seeing, this deepening relationship between the United States and Saudi Arabia and the Middle East. One of the key contentious issues on one hand is the oil conversation. We know that Saudi Arabia is trying to get more market share, and OPEC is. The United States at the moment is the biggest oil exporter. The other is defense purchases from the F-35s, which are a very contentious issue. Israel is the only country in the region that has access to that technology.
And now the conversation is about letting Saudi Arabia have access to that conversation and designating Saudi Arabia a new category of ally, a non-NATO ally, which gives them access to finance, priority access to some ammunition, some military products, and able to do joint R&D as well. So sort of fully bringing into the fold Saudi
And
Arabia.
semiconductors were part of the discussion yesterday. The CEO of Nvidia, Jensen Huang, was at the dinner at the White House yesterday, seated very close to the head table. And, you know, these deepening economic ties, also AI and chips is playing a big part of that.
Yeah, absolutely. So we'll continue to watch that one. Coming up on the programme, a French court rejects a complaint against Nestlé's Perrier water. We'll see if that boosts the company's shares at the open. Plus, we'll cross to Johannesburg, where Bloomberg held a very eventful Africa Business Summit. We'll bring you plenty of the highlights from some big newsmakers at that event. Up next, tech valuations weigh on markets as investors await Nvidia earnings today. We'll talk markets. If you have any questions for our guests, please do send them to us. IP plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
We have to make a decision with public markets and private markets also, okay? Because the private markets generate a lot more capital today, support business activity and so on. So I tend to agree that if you look at the public markets, there are risks there for sure. You know, we can call it valuation bubble, etc. For sure.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Those were just some of the big interviews from Bloomberg's flagship New Economy Forum in Singapore, including the CEOs of Algebris Investments and Temasek, along with the former Barclays CEO and current boss, of course, of Atlas Merchant Capital, Bob Diamond. Valerie, take us through your focus on the markets today.
Well, it's squarely on the equity market and whether perhaps we are going to be on a firmer footing headed into these Nvidia results later tonight. Perhaps this is giving us the early signs that this correction might be coming to an end, but it has been a decent four-day slide when it comes to the S&P 500 index, its longest losing streak since August. In the last 5 sessions, we look at S&P futures, flip the board, we're down around 3.6%. So yes, a healthy correction on our hands. The Nvidia results tonight will probably tell us whether this correction does continue or we bounce higher from here. But I want to add another risk event on the horizon. We heard from Treasury Secretary Scott Bessent yesterday speaking to Fox News, teasing the fact that they are presenting a limited number of candidates to President Trump after the Thanksgiving holiday, and they aim to choose the Fed chair before Christmas. Kriti?
A really fascinating conversation there. I thought it was really interesting that he said that Bessent was his preferred choice, but that Bessent didn't want the job. Let's see if that actually makes a difference. We have the perfect guest to talk about it. Kamaksha Trivedi, Chief FX and Emerging Market Strategist over at Goldman Sachs, joins the program. So what do you make of it? We'll start with the Federal Reserve. We'll broaden out to other central banks in a moment. What do you make of it? The market has done a complete 180 in terms of guaranteeing rate cuts to maybe saying, oh, wait a second, that's not kind of what we're hearing out of these governors. Is what I was going to say government officials, governors, although these days they kind of are interchangeable, aren't they? Talk to us about your view.
Yeah, good morning. So, look, I think you're right that we've gone from being, as you said, very, very fully priced to now less than 50% priced for December. I think it's a key meeting. I'm also a little bit worried about the actual reopening and how that plays into the data calendar here, because the Fed meeting is early December. If we don't get the kind of, November payrolls data by then, even with the avalanche of data that you will get, it won't be a very current mark-to-market on where the economy is. And you did hear from a number of, Fed people that, if there's a data fog, you slow down. And so there is some risk here. The hawkish risk here I see is that they just don't feel that they have enough of a grip of where the economy is, how, what is the shape of the labor market to sort of commit to it. Our baseline expectation is there'll still be enough of a majority on the committee to go in December, but the hawkish risk is that they decide, well, they might still do it, but maybe wait till they get all the data, and that might not be in time for the December meeting. Can
you explain just the thinking behind the hawkish risk? Because you do start to have hawks kind of emerging from the Wall Street community, but from the governors as well. But they're relating it to different issues. Some are saying that the tariff read-through is going to come late. Some are saying that the fiscal stimulus is where it's going to get exacerbated from the one big beautiful bill. Now we're talking about $2,000 dividends, the tax cuts, et cetera. If we do start to see that uptick in inflation, where does it come from?
Yeah, I mean, look, I think you have seen at least some limited pass-through from the tariff side of things. But what is also true is that you're seeing more exclusions on the other side. So the effective tariff rate, is beginning to come down slowly, partly from the exclusions that are being put in place, partly also from the, deal and agreements with China. So I think from from that inflation side of things, there is some in the pipeline. But I think if you're looking forward, I think it's fair to say that you're probably going to see that, come off a little bit. To me, it all boils down to the labor market. I think how much risk you want to take with that. And I think that there, I think, is where you are beginning to have some difference of view. And that is where actually real data would help, because you have seen some signs in the layoff rates and things like that while we've been in the shutdown that things might be deteriorating.
Yeah.
And I think that's something that the Fed will not want to run that risk very far.
Okay, so we need a bit more clarity on the labour side. That would be really helpful at this point then, Kashoggi. Let me ask you about the link between, so with the dollar in focus and thinking about where the Fed goes, I'm wondering what the read across is from the AI drama that we've seen playing out over recent days. You know, what is the link between the US economy and its leadership in AI and the dollar? Is there one, or are there other links I need to be aware of?
I think there's definitely a link. I mean, if you step back a little bit, right, like the American exceptionalism trade, you know, going back a year was a very broad one. It was about the economy, it was about the labor market, it was the tech sector, it was the corporate sector, it was credit markets. What has happened to some extent over the course of this year is that exceptionalism has narrowed. It's become primarily about the corporate sector. It's become primarily about the tech sector, AI, as you were just saying. The economy has weakened somewhat this year. The labor market is on a softer footing, like we were just talking about. So I do think that the tech sector strength and buoyancy has actually been more important to the dollar holding up and not weakening further in the second half of this year. And so if we see kind of real cracks in that, if we see sort of a proper questioning of that tech sector exceptionalism, I think that probably does come alongside a renewed weakening in the dollar. So I think it is important.
And whilst we're thinking about things that could or might add to or detract from risk appetite, we've seen some interesting geopolitics around China and Japan. And with your emerging markets hat on, if we can think about where this takes China and I guess Japan. China saying this morning they will act if Takaichi, the Japanese Prime Minister, of course, does not retract her comments. I'm not sure if anybody thinks that is likely to happen. I mean, is this likely to take the edge off asset performance in any sense?
Not in a medium-term sense. I think that, you know, you do have these, you know, occasional, you know, escalations in tension between Japan and China. Maybe you have a new prime minister who's kind of trying to kind of, you know, burnish their own hawkish credentials on security side. So perhaps that explains some of this. But no, I think in the medium-term sense, I think this will remain a relatively local issue for particular stocks and for those economies.
There's been a lot of chat in the last few days about the sell Japan trade, because we've seen amidst this spat with China a pretty substantial weakness in the long end of the JGB market. What do you think about that discussion?
I think that is more related to the fact that you're seeing, you know, some fresh impulse towards a bit of fiscal stimulus. I think, you know, there was an expectation that, you know, with the surprise victory in Japan, that you would see a shift towards perhaps another kind of Abenomics that led to sort of, you know, delayed, you know, hiking cycle, perhaps more fiscal stimulus. I think you're going to get a muted version of that. I think the, you know, global market environment is much less forgiving of a big shift to fiscal stimulus. So I think you'll get a smaller version of that. I also don't think that, you know, inflation is that popular in Japan. So I think yen depreciation, while it can run further on crosses, is going to have a, you know, smaller role to play relative to the first big iteration of Abenomics that we had. So, you know, yes, a little bit of move in that direction. I think it's reasonable. I think that's what we are getting. But I think people should know that we are playing for smaller stakes here.
Okay. Thank you very much. Thanks for your thoughts this morning. Kashoggi Trivedi, Chief FX and Emerging Market Strategist at Goldman Sachs. Coming up on the programme, the CEO of the UK-listed software group Sage joins us on set next. To talk about the company's earnings, we've got a buyback in the works. We've got commentary around the full year to get into, but also the wider tech picture ahead of the budget in the UK. All of that next. This is Bloomberg.
Thirty minutes away from the start of the opening trade. When you look at the futures picture, remember we've had a very volatile week earlier this week. We are starting to see a little bit of green on the screen, perhaps breaking through to the upside, but not with a ton of momentum. It feels like we're in a wait-and-see kind of mode. Over in the States, you are seeing futures, I want to say just virtually flat, literally higher by 1.7 points. FTSE 100 futures higher by 0.1%. Val, I'm not going to put a ton of stock in this equity picture because I feel like after Nvidia today, it's all going to change.
Yeah, well, look, the equity market has really been the the key for the market driver this week. Let's take a look at how European fixed income is opening. It's opening up pretty steady across the curve. There hasn't been a lot of drama in fixed income. Obviously, the eye is on whether the Fed will or will not cut in December, but we've had a pretty stable bond market even through this equity market weakness in the last few sessions, and it seems to be the same flavor today amid the mixed equity market picture.
Let's get back to the earnings story, and it's a timely conversation. We need to talk about the numbers coming through from Sage Group this morning, UK tech-listed business, of course. Pre-tax profit for the full year, pre-tax adjusted full year, coming in at 555 million, broadly in line with where the market expected it to be. A share buyback program being announced, and some guidance on margins for 2026 coming through. All of this very timely on the day that we hear from the giant of the tech space, Nvidia, and also a week ahead of the UK budget. Joining us now then is Steve Hare, the CEO of Sage Group. Steve, very nice to speak to you this morning. Thank you for joining us. So let's start with the numbers then. I mean, broadly in line, is that it seems to be from that pre-tax number. You're giving a little bit of guidance about 2026. What is your outlook? What's your message to markets?
Yeah, the message is very much that, it's the fourth year in a row that we've delivered double-digit annualized recurring revenue, and the margin has been increasing. So, earnings per share up 18%. So hopefully the market will see this as very reassuring, and more to come next year.
More to come next year, and a lot of excitement, of course, around the tech space. What kind of adoption rates are you seeing around AI products, AI technology? I know that we've talked in the past, and you've said, look, AI's been around in certain forms for a long time, but we must be seeing huge step-ups in adoption rates by customers and the way that you're using it internally. So what's the latest insights on that front?
Yeah, so we are, but I think it's always worth remembering that small, mid-sized businesses, they don't buy AI because it's AI. They buy things because AI enables them to save time. So I've yet to hear a small business owner say, "Oh, I must buy some more AI." They're buying solutions which ultimately save them time. But we've launched Sage Copilot in the UK. It's been in the market for about 6 months. It's now available to 150,000 customers. And we have numerous examples of customers saying it's saving them, 10, 12 hours a week of admin. And as we all know, nobody went into business to do admin. So, for small business owners, this is real game-changing stuff.
How do you think your business is set up to handle competition? A lot has been said about how these traditional software makers are either going to do very well or do very badly versus these new AI incumbents. How do you see the landscape in your business lines?
Yeah, I think the key thing is that we made a decision very early on to develop our own domain-specific LLMs. And I think in our industry that's very important. Finance, workflows, they need to be accurate. And so, our machines, our AI, are learning from a very rich data set because we have such a wide number of customers, small, mid-sized businesses in many countries. So, we have over 40,000 models learning as we speak, training on our proprietary data. And I think that means that, having this large install base is a huge advantage.
Are you seeing a difference in how perhaps you're projecting sales cycles to unfold now that you have these AI instruments? Is it going to help you retain clients, or perhaps be a longer sales cycle? How is it going to change the landscape of new products?
Yeah, it's really interesting. I think there's two sides to this. Actually, what AI allows you to do is do things faster. So we've been experimenting, for example, with AI agents doing lead generation, doing lead qualification, so interacting, with potential leads and answering basic questions, etc., which really speeds things up. But the flip side is small, mid-sized businesses, particularly this side of the Atlantic, are traditionally a bit slow to adopt latest technology. So just because the technology is available does not mean people will adopt it. You have to build trust. They have to build up use cases, get happy with it. And so I'm seeing both excitement and caution at the same time.
Well, speaking of trust and excitement, there is a big concern right now in the tech adoption sphere of this kind of cyclical move that you're starting to see in innovation and investment and lending, and this very kind of interrelated and intertwined relationships that you're seeing between the hyperscalers and the innovators. For an adopter like yourself, How are you viewing that? Is that concerning to you, or is that normal?
Well, the problem is actually I'm of an age where I can remember the dot-com crash. So there are some similarities here with what
I never would have guessed.
happened in the late 90s. But look, from our perspective, we're not. The infrastructure needs to exist, but we're selling solutions, we're selling applications, and so when I sit down with customers, I sit down with prospects. What I'm always focused on is how can I save you time? How can I release you so you can spend more time running your business? And that conversation is a conversation we've been having for many years. It's just AI allows us to create this productivity much faster than we've been able to do in the past.
You just mentioned the dot-com bubble, though. Is that what you're seeing right now? Is that where we are?
Well, I think what we're doing, because we're delivering the applications, people need, they need these solutions, and these are real solutions for real people, right? These things are happening now. But if you look at what's happening from an infrastructure perspective, and it's not for me to comment on, valuations of the hyperscalers, but there does seem to be a huge amount of money being spent which is disconnected from the return on investment. So we'll see. In the end, you need to see the ROI, right?
Yeah, absolutely. Just linger a little more on the questions around AI. I mean, yesterday we saw OpenAI and Intuit striking a partnership deal. Now, Intuit maybe competes with you in some areas. They do other things that you don't do. But this partnership deal allows ChatGPT users to access some of the Intuit products, and it allows Intuit to get ChatGPT access. You've got your own Sage Copilot product. How does that kind of deal that they're doing with the big players in the AI landscape, how does that interfere or compete with what you're up to?
Yeah, I think there's two parts to this. One is how does a customer access what they want, right? So, whether you're going through ChatGPT or whether you're using Teams or Outlook or whatever it might be, how do you access what you need? And, we need to have flexibility so that customers can access however they want. But I believe very strongly, as I was saying earlier, that what you need to do is you create secure platforms where people can trust that their data is being protected, it's being used in the appropriate way. And, I always say to my customers, I am not going to release that data to other third parties. So you're not going to find your data in ChatGPT or anywhere else for that matter. It is within our platform, and we will protect that, and we will use our machines to learn from it so that you can get these amazing solutions. But where your data is.
Yeah, so it doesn't sound like the kind of deal that you're looking to replicate.
It depends where the data sits.
Right.
I don't know exactly the details of what they've agreed, but I think what's really important is that if it's an interface, that's fine. But I think as soon as you start releasing data to help other people's LLMs learn, I think that's a tricky area.
Steve, let's get to the fun stuff. We're a week away from the UK budget. You talked a little bit about being slow to kind of catch up to the AI boom in this region. What would you ask for if you're from Rachel Reeves in that budget? What does she need to create that kind of trust that you're talking about?
Yeah. Well, I was lucky enough to be at number 10 last week with a few other CEOs, and we all gave the same message, which is, the kind of current drip feeding of news is really unhelpful because all it does is create anxiety. What we need is clarity. I think the UK historically has had a great reputation for stability. At least you've known what you were dealing with. Even if you didn't like it, you knew what you were dealing with, and we tend to, create this stable environment. To get people to invest, and I think I would really emphasize, whether it be small businesses or medium-sized businesses, there is a lot of capital.
Yeah.
We need people to deploy that capital. To deploy capital, you need to be confident that you can invest something and the rules aren't going to change. So that's my real big plea is make your mind up, be bold, but then stick to it.
Were they receptive? Do you feel like they heard you?
Yeah, I feel like the Prime Minister, was very much in listening mode. But as you say, the budget's a week away. We need to get it out of the way. And whatever needs to be done, do it, and then encourage particularly small, mid-sized businesses to invest.
All right, Steve Hare, the CEO of Sage Group, walking us through the AI boom and, of course, the UK budget as well. We thank you so much for your time. Sticking with that same theme, coming up on the program, we're keeping our eye on European tech stocks at the open. Those valuation fears continue to rattle markets ahead of the Nvidia earnings report after the U.S. closing bell. That conversation next. This is Bloomberg.
Crypto is an investment area with its peculiarities and at times its own peculiar risks. On that one, it's just we go with our clients. And actually our regulators are quite happy that we get involved because that way they get a clear view of what is happening in this exciting, potentially exciting new area of the world. The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail, to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
That was Standard Chartered CFO Diego De Giorgi speaking to me as part of Bloomberg's Chief Future Officer program. We went on to talk about the potential for stable coins. You can catch the full conversation, the full show tonight, 9:30 p.m. That is Wall Street time. Times in other regions vary, and they were on that graphic that we just showed. But Kriti, there he was making the sort of long-term, medium-term case for looking at, thinking about, providing access to all kinds of digital assets, even if in the very short term, the questions around crypto, specifically Bitcoin, are very different.
It's fascinating. Is crypto leading the tech sell-off? Is the tech sell-off affecting the sentiment around crypto? Regardless, we can know for sure that at this moment in time, they are very much intertwined. But to me, what is, I think, interesting for the people that are making the argument that crypto is at the end of the day leading some of the tech sell-off is the fact that maybe it's not as volatile of an asset as it used to be. And that's where this chart comes in handy. Bear with me. It's a little messy. I'm going to walk you through it. This is basically a one-year chart of the one-day percentage moves of Bitcoin. So on 1 year, you're looking at the standard deviations, basically how normal is it for a Bitcoin move to happen, and what is normal for a normal Bitcoin move? Well, you look at back when Donald Trump was inaugurated, that's this blue line over here, an average standard deviation was much, much higher. We're talking about 3-4% moves. You get closer to the congressional acts that actually validate some of the crypto moves, that volatility comes down. Now a 1% standard deviation move is only 2% for Bitcoin. That is normal, coming down from 4% at the start of the year. And significant because that sell-off that you've seen, even when it hit that below 100,000 level, that's what that blue line is there, it only dropped gradually relative to its history. 2% declines every single day, still within its one standard deviation. And Val, I think that's really interesting that Bitcoin, cryptocurrencies that are kind of seen as this volatile, jittery indicator, right now, they kind of seem relatively stable to what we had earlier this year and in previous iterations.
Yeah, I think it'll be interesting, Kriti, whether it follows the NASDAQ in its next move. We do have crypto, or at least Bitcoin, in the red this morning, down 0.7%, trading above 90,000. But the next major test for markets and for techs will be the third quarter earnings from the world's most valuable company, which we're expecting around 9:20 p.m. UK time later this evening. Let's get more on Nvidia with Bloomberg intelligence analyst Matt Bloxham. Matt, when the lines drop, what are we looking for?
Yeah, I guess the current quarter print, so the market's looking for $55 billion of revenue. That's about a 57% growth year on year, and about $1.26 of net income earnings. And then perhaps more importantly, the forward guide, their Q4, so maybe about $62 billion of revenue. So that would again be kind of 58% year on year growth. And I think beyond that, it's the kind of narrative about where is the natural demand. Obviously, most of their spend is coming from the big hyperscalers. There's this kind of question mark about circularity of their revenues. I'm sure they're going to get lots of questions about that. It's what evidence can they start to show the market that enterprises are spending more on AI, that they're getting a return on that investment, and that you're going to start to kind of see this move on from this current cycle we're in.
Yes, and so Matt, you've gone some way to answering this question,
yep.
but what is it that investors are going to be looking for here that will convince them that we're not in a bubble, or even if we are in a bubble, that it's not about to burst very quickly, which is perhaps saying a bit different.
Yeah, I think they're going to struggle to offer anything that convinces people of that. You know, the market's kind of really being quite stretched now. You know, really, we're in a cycle that's going to last well into 2026, where most of their revenue comes from the hyperscalers who are in a big investment cycle. You know, we've heard that all of them admit openly that maybe they're over-investing, but they're not going to stop that anytime soon because they see this as the kind of next generation of their businesses and they can't afford not to invest in it. I think the question marks come sometime next year when if Meta or Google start to kind of show some chinks that actually this big investment isn't paying off in terms of more revenue or better bottom line performance. That's when their investors say, why are you spending so much money on this technology without the proven demand? And that's when the kind of bubble, if you like, might start to deflate or perhaps deflate spectacularly, maybe.
Other euphemisms for burst are available.
Pop is where I'm going to go with Bloomberg intelligence analyst Matt Bloxham walking us through what we're going to learn from Nvidia after the bell. Let's zoom out a little bit more, get a bit of a more macro take here. Skylar Montgomery-Koenig from the Markets Live team is also around set. Skylar, we're citing this as the big macro risk event because of the stock market volatility. We've also seen some of the correlations drop, Bitcoin aside, between what you see in the stock market and what you see in other parts of the market. Is this as macro of an event as everyone thinks it is?
I mean, yeah, certainly it's a very macro event. So my colleague Mark Cudmore has done work on what happens exactly after Nvidia earnings are released. And what you typically see is that, yes, Nvidia earnings are actually usually very good. They kind of support what we've seen from the rest of the tech sector in that those earnings validate your valuation. So there's a reason the valuations are so high. But despite that, you get a sell-off in the days following because it's just not enough for the market. And because earnings in Nvidia matter so much globally, or to earnings generally, the overall picture, you get feed through to other markets as well. So something like the Euro stocks is only 13% tech, but I would expect to see a feed through to the Euro stocks as well. And understandably then, something like tech or industrial is more susceptible to that sell-off. Whereas if you look at, say, utilities, that's more of a defensive stock, that might outperform.
And what do you think about the correlation to cryptocurrencies? Do you think that will stick? We've seen a big drawdown in Bitcoin alongside this NASDAQ move. Is that a correlation you think will continue?
I mean, yes, I think the correlation naturally happens because you have things like retail flows that go into both. People are looking at the markets and naturally linking them. I don't think I have a strong view on crypto generally. I worry about assets that you can't value. There's not a way to say, oh, this looks reasonable or not. You also have big volatility moves, as was talked about previously. And so as you get this big gyration, it doesn't necessarily mean that there's an impact in other markets, or you'd at least expect the scale of the translation to be smaller.
And Skylar, you've actually been comforted by the extent of the pullbacks that we've seen in markets. They haven't been panic. I know Cameron Christ was writing something similar to this yesterday. They haven't been panics. Yes, we've seen the VIX spike, but maybe that's rational given where we are in valuations and the narrowness of the market.
Yeah, I mean, when I think about whether or not the market's going to be okay, I'm very comforted by the idea that people are very worried. So if you look at something like the AII bull bear indicator, people are more bearish than not. And typically what you see when a bubble pops is that you get this irrational exuberance. And so the fact that we're not seeing that, to me, is very much a positive sign. I think something that's also worth highlighting is that valuations are not a catalyst. Yes, you can be nervous because of valuations, but it's not a reason for a sell-off. And if you think about the current market we're in, yes, you're likely to see wobbles along the way. We're getting a very chaotic U.S. data release schedule. Yesterday, we had jobless claims released at something like 4 a.m. Eastern time. So that's quite unusual, and you're likely to see volatility induced from that. But the fundamental backdrop is still quite strong. So if you think about what we saw at the beginning of October, that continued or had this wobble. It was 3 negatives. It was the fact that the U.S. government shut down, China-U.S. trade was going poorly, and people were thinking about a more hawkish Fed recently. But I don't think any of those have gone negative. So you have a trade truce, you have Washington reopen, and the terminal rate for the Fed is still 3%. So that's easing. That's positive for equities.
Skylar, thank you very much. Skylar Montgomery-Koenig from our Markets Live team with a rundown of some of the market themes that we're watching. She mentioned Mark Cudmore. You can get insights from Mark Cudmore and all of the Markets Live colleagues on the Bloomberg terminal. MLIV Go is the function to use. Let's get a rundown of some of the stocks we're watching, including tech. Here's Chloe.
Good morning. So today we are watching the tech stocks ahead of Nvidia's earnings later. So of course we're going into those results with growing concerns over the valuations in that tech sector. So all of that has consequences for all of those names that we've got up here on the screen. The problem is that the expectations are getting higher and higher, and that is making the bar more and more difficult to clear. So that is something that we'll be keeping in mind today. And let's see how investors think about what that means for those tech players that we have got here in Europe. Moving on to Nestle, which could also be on the move today after a French court rejected a complaint about its Perrier water. So a consumer rights group had accused Nestle of mislabeling the Perrier water because of the use of filtering methods, and that meant that it was not a natural mineral water. That complaint was rejected. We could see that potentially boosting the stock this morning after a bit of a turbulent year, but some gains recently that could be sustained on the back of that. And finally, BPER, Banca, an Italian bank, could also be on the move today after La Stampa reported that UniCredit might consider it as a potential takeover target. Of course, UniCredit is no stranger to takeover battles, but the two recent efforts with Commerzbank and Banca BPM have been thwarted. So let's see how this one fares. BPER Banca has been seeing quite an impressive rally. Let's see if it is sustained this morning on the back of this potential offer there.
All right, thanks to our equities reporter, Chloe Melly, walking us through some stocks to watch ahead of the cash equity open in just less than 5 minutes' time. Keen interest, I think, is going to be on the tech space ahead of these Nvidia results. If we see a bounce today in European tech, maybe we'll be on a firmer footing on Wall Street ahead of the earnings.
Right, that's an interesting point. Yes, and US futures just perking up a little bit, but pretty flat as we wait for those Nvidia earnings. We'll focus in, as Chloe mentioned, on possible consolidation within the banking space in Italy. Feel like we've been here before, though. Coming up, we'll bring you the start of European trade. This is Bloomberg.
Few minutes to go until the opening trade. It feels like we're on wait-and-see mode just a little bit, and I think yesterday's price action might be a good indication of that. Well, since the S&P 500, of course, going into the European session, that overlap that you see until the European markets close, and then you started to recover just a little bit, emphasis on just a little bit, because it kind of feels like we took a round trip throughout the session. Val, I think what's really crucial here is everyone's waiting for Nvidia.
Everyone's waiting for Nvidia. We have over 12 hours to wait, unfortunately. Let's see how this European session fares. We are looking a bit positive when it comes to the futures picture. The Euro Stoxx 50 futures just clinging on to green, up 0.1%. FTSE 100 not so far behind. DAX futures in the red. So it is a bit of a mixed picture. We're waiting perhaps if we can feel a firmer footing when it comes to risk sentiment ahead of the big Nvidia earnings out after the bell. Anna?
Let's talk about some of the other sectors and stocks that are in focus this morning. And tech is never far from our minds this week. And Valerie, you were making the really good point earlier that, however tech performs today could tell us something about the mindset of investors going into those Nvidia numbers later on today, which of course will be the game changer, or has the potential to be the game changer. US futures are pretty flat, but we'll watch how European tech names respond today. BPER Banca over in the Italian banking space. This is the latest name to be talked about as a potential target for UniCredit. Stampa over in Italy saying that UniCredit may consider BPER as a potential target, and that is having an impact on how it's trading ahead of the open, so we'll watch that. And AB InBev in the drink space, Wall Street Journal has a story about the potential for this business to do a $700 million deal for the party punch maker Beatbox, so we'll watch consolidation in a couple of different parts of the market this morning then, Kriti.
Who knew Party Punch could be such a stock moving event? Nevertheless, let's get these markets open, because of course there's plenty of sectors that we're keeping an eye on. We mentioned the tech sector, defense in there as well. Lots of geopolitics as well, walking in through from Zelensky to the comments we heard from MBS in Washington. Right out of the gates, we're seeing FTSE 100 kind of not giving us much action, very, very flat. But again, keep an eye on the DAX, keep an eye on the CAC 40, keep an eye on the IBEX, because these are the places that where you have seen the most volatility. The CAC 40 getting their cue from the weakness you're seeing in China. The DAX, of course, very exposed to that defense story, and of course even the IBEX and the FTSE MIB, that banking story is going to permeate through. Lots of individual stock stories, Val. How do the sectors look?
Well, look, it is looking pretty mixed when it comes to the sectors. We do have around 12 in the green, the remaining 8 in the red. So pretty split as versus to yesterday's session where all sectors closed in the red. At the top of the basket is energy. We're seeing the likes of Shell, Total Energies, and BP, some of the biggest points gainers in the Eurostoxx 600 just in the first few moments of trade. At the bottom of the basket, maybe not surprisingly, is technology. It was a soft close for the NASDAQ late last night on Wall Street, Nvidia being the main points loser to the downsides. That does point us a bit softer when it comes to European tech shares this morning. But broadly, we have 333 shares in the green, only 216 in the red. So more up than down so far this morning.
Yes, more up than down, which tells you something, doesn't it? And technology was by far and away the biggest loser straight out of the gates, but has pared some of those losses just a little bit, Valerie. And now it's just down 0.2% as a sector. And the worst performing sector is utilities, which, you know, that's linked, I guess, but also tells you something about where the market's thinking is. At the top of the market, then, Valerie, you flagged energies. I mean, all of these technology, utilities, energy, they're all part of a similar theme sometimes. Today's market is looking at things differently, and it's not part of the same theme. Energy is higher by around 1%. It was interesting yesterday that tech was weaker in Europe, but actually it was things that were just cyclicals, like autos, banks, basic resources. They were the weakest performing sectors. Today looks a little bit different, and we do have that slight balance to the upside as the Stoxx 600 tries its hardest, Kriti, to go higher.
It is shocking to me that we're seeing energy in the green right now and driving the markets higher, to your point, because we're looking at Brent crude prices that are actually pairing those initial gains from the session. 64.452 is where we are on that. And this is coming in the background, by the way, of some of the geopolitics that we've seen, the background of the conversation between MBS and Donald Trump in Washington yesterday. So interesting to see how much of that shakes out. And, of course, the sanctions conversation, which is kind of lingering in the background. I should also mention that Roche is having a second positive day. Yesterday, we saw it was moving the market quite a bit and leading the healthcare sector to the upside. It feels like it's a similar story, I should say, today. Let's talk a little bit about some of the other commentary we're hearing as we're talking about valuations or we're talking about a potential slowdown. Well, Goldman Sachs president and COO John Waldron spoke about those very topics at the Bloomberg's New Economy Forum in Singapore earlier. Take a listen to what he had to say.
There's been, equity markets, IPO markets much stronger. So we've seen a lot of deployment of capital this year, and I would expect that to continue in 26 if we have that underlying economic backdrop that we're expecting. It may move around the world in various ways. I think the notion of all this money running out of the United States was declared much too early.
Joining us now is Patrick Brenner, multi-asset CIO over at Schroders. Patrick, welcome to the program. Thank you for joining us this morning. I'm going to ask you maybe a little bit of a strange question. What are you worried about the most? What keeps you up at night when it comes to these markets? I could give you a laundry list, but I'm curious about what's top of your worry list.
Well, I think probably the biggest worry is that our baseline scenario of a very low probability of a recession in the U.S. Could be wrong. I mean, that's probably the biggest risk from a fundamental perspective because, when we look at the fundamentals, the situation is still pretty good. We think the labor market is in this low hiring environment, which is not a bad place to be. Real wage growth continue to be supportive for the consumer, which is the backbone of the U.S. economy. So I think that's probably what keeps us awake, if we were to be wrong on that side. The other side, obviously, I'm sure we might touch on that, is AI. If we were to see some bubbles around, some waves around AI, that will obviously has the potential to distort markets going forward.
Well, to your point, it's very timely to have that conversation, given we have those Nvidia earnings after the bell. Walk us through, though, the outperformance of tech or underperformance of tech that could be emanating out of the United States. What is the read-through into European stocks?
Yeah, I mean, it looks right now, to be honest, that everything seems kind of correlated, right? I mean, our sense is that the recent corrections we're having right now is actually more driven by liquidity than by anything else. And I think, if you look at the internal market dynamics, it's interesting, actually, you will see that those U.S. large cap, high quality tech names actually have been holding up pretty well. And for us, this is kind of indicating that this is probably more liquidity driven than fundamentally driven. And what we are seeing on the crypto side is probably going in the same direction. But when we look at the fundamentals, actually, we think that the picture is not too bad.
A question, though, you're tying this recent struggles in the equity market to the liquidity picture. It's tied to the Federal Reserve, the recent hawkish comments we've gotten out. That does seem to be there is some sort of issues going on at the Fed in terms of what to do with this December decision. How are you viewing the fact that at least we've not gotten a clear update from the Bureau of Labor Statistics. It doesn't seem like they're going to clear this backlog before the Fed convenes again. They're still going to be in a data fog when it comes to that December decision. Do you think that means they're going to be on hold?
Look, I think clearly we've been flying a bit in the dark recently with the U.S. shutdown, and it clearly increased uncertainty around macro data. And I think to some extent this probably explains why some of the pricing around the December cut have been repriced. And to us, it does explain why, to some extent, this is kind of tightened the liquidity condition recently in the market, and probably explains the recent correction. Going forward, we still believe the Fed is going to cut in December.
Yeah.
So we think that with having more clarity going forward, both around the labor market but inflation, there is more space for the Fed to cut.
So if you're assuming that the Fed is going to flip to maybe a more dovish stance, are you buying the dip here? Is that one reason why you think this equity market could rally and you see value in this drawdown?
So we're staying positive risk. We've been positive equity for most of the year, and again, we don't see that further than just a correction, so we're happy to stay long equity at this level.
Patrick, talk to me about the link. You started this conversation saying to Kriti, one of your biggest, well, the thing that you would worry about is if the economy in the United States didn't turn out as you expected, and your low probability of a US recession turned out to be worse. What's the link between that and the job story right now? I mean, because it seems as if we could get some negativity around jobs. But certainly big tech names could be doing just fine and could be telling us a different story about America's prospects. I mean, where are you focused? Are the cracks that we always look for, are they the same?
I think you need to look really at both. I mean, it's with no doubt, what's happening on the high story is driving markets. I think no one is going to deny that. But equally, it is important to look at what's happening in the underlying economy in the US, and we believe that the labor market is still critical, right? So having the right call on the labor market, we believe, is still something that we should look. I mean, right now we are in a position we believe fundamentally where the labor market is all right. We think that the AI cycle is not over, so there is probably more room to go there. So again, this is all supportive for a long equity position.
And I guess you'll be looking for the sort of cyclical and the structural when it comes to that labor story. What about gold then? Because you're still pretty positive on gold, even though you don't want to turn fully defensive on your portfolio, and you're hopeful about the US economy and AI, but you are also buying gold, I understand. So what's the story there? Yeah, I mean, despite the recent volatility that we've seen in gold, we still believe that gold has a role to play in the portfolio as a diversifier, especially in an environment where there is growing concern from investors around the role of the US dollar and US Treasury in the portfolio to kind of diversify the long equity risk. And with that perspective, we still believe that it does make sense to continue to hold gold in the portfolios.
Do the lack of correlations right now matter? And I know you kind of said everything is a little bit correlated from the equity perspective, but it doesn't feel like this bond market is responding to the dollar or vice versa. It doesn't feel like the equity market is watching what's happening with the bond market. Are you seeing that? Is that a problem?
I think it's really tough right now to find uncorrelated negative correlation in the markets. It clearly seems that there is one big trade. And I think I'm going back to my point around the liquidity. It does really feel that the market is very much liquidity driven. We mentioned about the repricing on the front end of the curve, which probably has tightened financial condition in the US. Maybe you should talk about also the tightening in liquidity that we've seen from the rebuilding in the TGA, in the Treasury General accounts. Clearly, this has been a drain on liquidity. But now, with the U.S. administration reopening, I mean that should resolve it by itself. So, hopefully, those liquidity drains should continue to slow down, and we should hopefully come back in a market which could be more fundamentally driven, and then going back into those more interesting correlation features.
Patrick, given a lot of your thesis is about the liquidity issues or maybe lack of issues that the Fed is responding, we have seen that tri-party repo rate move above the Fed's upper bound of 4%, and the Fed has mostly been on the sidelines. Now, some are viewing this as a big departure because the Fed, since 2008, the 2019 repo blow-up, has always responded aggressively to hiccups in repo rates, but they've not done so this time around. Does that tell anything to you?
Well, I don't think I don't think the Fed is in a situation where they want to tighten liquidity conditions. So I think, when they feel that there is a risk around, a systematic risk around the financial system, I'm pretty sure they will do whatever is necessary to keep sufficient liquidity in the market. So that's not a big worry to us right now.
Okay, Patrick, thanks for putting that back on our radar. Thank you very much for joining us. Patrick Brenner, multi-asset CIO over at Schroders. Let's have a look at some of the core six and how they are performing. It is a day to think about technology, so we do that this morning in the shape of ASML here in Europe. One of the weaker parts of the market yesterday was anything to do with the semiconductor space. ASML is down by 0.5% this morning. Schneider Electric also down 0.6% with its links to big tech. That is of interest. Elsewhere, though, there are areas of green we see from pharma to defence to consumer goods. Let's get an update on some of the individual stocks in focus. Chloe Melly has a briefing. Chloe.
Good morning, Anna. Let's start with that utilities space. And we are down across NL and Endesa this morning after both of those companies were cut at RBC, with analysts saying that the expectations were maybe a little bit too high for those companies and valuations were also a little stretched. So we are down 1.5% for NL and 1.8% for Endesa this morning on the back of those downgrades. Moving on to WH Smith, which is also in the red today. We're down 1.5% after the CEO resign, and that follows an investigation into an accounting error which forced the company to earlier this year slash its profit outlook in North America. The discovery of the accounting error led the shares plunging earlier this year over the summer, and now the resignation of the CEO following the investigation is also sending the shares down this morning. Moving on to SMA Solar, and this company, which is a provider of solar energy equipment, was raised to a buy rating at Jefferies, with analysts saying that the company had weathered the worst and was now set for an improvement in profitability going forward. And that is really driving the shares higher this morning, and we are up 6.7% for that company. And finally, let's end on another positive move. And Sage, which is a provider of payroll software, is up after announcing a new buyback and also a very positive outlook. And that is despite the fact that profit missed expectations for the latest period. And we are up 1.25% this morning after this outlook and this buyback really reassured investors.
Chloe Melly from our equities team, thank you for running us through the stocks on the move this morning. Coming up on the show, we'll get into the details of the UK inflation print after we receive the first fall in the figures for 7 months. More on that next. This is Bloomberg. Welcome back to the opening trade. We're near 17 minutes into today's cash equity session here in Europe, and we have broadly flipped into the red across all major indices. Euro Stoxx 600 down 0.2%. The CAC 40 is underperforming this morning, down near 0.4%. And S&P futures over on Wall Street have now flipped into the red after briefly trading in the green in the last hour and a half. Well, now let's turn to the UK. UK inflation fell for the first time in 7 months this morning, with price pressures easing as traders add to bets that the Bank of England will cut rates in December. That odds have risen from around 80% to around 87% so far this morning. We are seeing a rally in front-end gilts. Those 2-year yields are down around 2 basis points. Well, joining us now to discuss this and more is Kit Reeves from our Bloomberg team. What's your read on the inflation print this morning?
Yes, so the big trend is that it's going downwards, which is probably going to be very welcome for the Bank of England and also for the Chancellor of the Exchequer. So there were a couple of positives, mainly the energy prices were the big downward contributor, which has been a big pain point for households, as well as household costs and rents. Yet there's still a couple of areas of concern. Food bills unexpectedly rose, which is a little bit of a negative. But we saw services inflation moderate a bit, and the UK is a big services economy, so this is really key, and this is something that's watched very closely by the Bank of England. But overall, even though inflation came in a little bit hotter than economists expected at 3.6% for October, it was in line with Bank of England forecasts. So overall, the trend is downwards, and this is seen as a positive.
Kit, I want to get your take on the budget in just a moment, but before I do, I want to just flag to our global audience that the London Stock Exchange Group CEO David Schwimmer spoke on this very topic exclusively from the Bloomberg New Economy Forum. He was talking about the UK budget. Before I come to you, I just want to flag what he had to say.
I think the important thing for the UK from an economic perspective is to make sure that its fiscal house is in order, to have the breathing room for investment, both public sector and private sector investment. I think there are clearly some fiscal challenges. There's some political challenges. And I hope that the government can put a budget in place that addresses those kinds of needs.
David Schwimmer there, the CEO of the London Stock Exchange Group, otherwise known as LSEG. And we should mention the parent company of Bloomberg News competes with LSEG to provide news, trading services, and data to the financial industry. But you can hear him talking there about some of the fiscal challenges in the UK. We are T-minus 1 week away from it. Kit, I want to bring you back in here. T-minus 1 week. Is anything, like, how much is going to change here? It feels like the plans are still waffling. Does today's print change the course that we're already on?
It's hard to say, really, because inflation is still higher in the UK than in other European countries. So it's still a very big and a very salient issue, especially for voters. So it's probably unlikely to move the needle very much in terms of impacting Reeves' thinking. She has pledged measures to bring down the cost of living. So this is probably still very much going to be a focus. We're probably likely to see some kinds of tax hikes. But overall, it shows that, inflation is still high. It's coming down, so the trend is positive, but we're still not quite there yet.
And we've had some comments coming through from Hugh Pill around inflation. I mean, this was yesterday before this data hit, but he was saying that the level of inflation is sort of the headline number overstates. You're right to point out that it's high compared to other countries, comparable economies. But he's sort of suggesting that actually there are, beneath the hood, there are lower pressures. There's a lot of regulated stuff in that headline inflation, isn't there?
Yes, definitely. And, if you're looking at services, that is coming down. So I guess there could be made a case that perhaps its headline inflation isn't as bad as, what's going on in the underlying economy. But we still see things like food prices, which consumers, that's very salient for consumers. Households obviously keep an eye on grocery bills. And overall, in terms of what it means for the Bank of England, the last vote was very close to call. Hugh Pill still said that, cautioned against lowering interest rates. So we'll have to see, if this changes the Bank of England's thinking. Markets are pricing in a rate cut for December, so it could be likely, but still there's a lot of moving parts, and we'll probably have to wait for the next inflation print to see, to really confirm this downward trend.
Yes, and of course there's the budget in a week. Thank you very much, Kit. Thanks for joining us. Bloomberg's Kit Rees with the latest on the UK. And with the UK in mind, we want your questions. Join Kit Rees and the Bloomberg Markets Today blog for a special UK budget Q&A. That's 11 a.m. London time. It's taking place today, so a week before the budget. They'll be discussing what could be in store and what it means for those in the UK for their money. Send your questions to marketstoday@bloomberg.net. And the UK Chancellor Rachel Reeves is expected to deliver her budget at 12:30 p.m. London time next Wednesday. Viewers in the UK and Europe can join us for a full coverage and analysis leading up to the budget statement, and of course, some response from the opposition and indeed some analysis off the back. So, Kriti, lots of ways to get involved in our budget coverage.
Absolutely. Let's go to another part of the world that we're keeping a very, very close eye on. That, of course, is what's going on in Asia. China escalated its retaliation against Japan, suspending imports of Japanese seafood and halting approvals for new films. And more signs that the diplomatic spat is far from over, despite efforts from the Japanese. Bloomberg's Winnie Su joins us from Hong Kong. Winnie, just walk us through the developments of the day. It feels like this is becoming a more volatile situation than a lot of people would like.
Yeah, exactly. We are really feeling tensions escalating pretty quickly here. And that is also felt in the markets. As you can see, over just the past 3 days, the Topix is already down about 4% so far. And that's the broader implication. And now, especially with China saying that they might going to act if Takaichi does, or if Japan does not walk back these comments. And Japan saying that they are willing to have more conversations with China. And in these specific sectors, you can also see that, for example, in the seafood sector, we were seeing the Chinese seafood names rising while the Japanese ones were down after Japanese local media said that they are hearing Chinese officials saying that they were going to ban seafood import from Japan. So that kind of escalation is really being felt in different sectors today. And we are very closely monitoring what's going on between the two countries here.
Winnie, how are investors hedging against a possible further escalation of these tensions between China and Japan?
Yeah, exactly. They are really looking for the pockets of opportunities and, more importantly, which sectors to avoid at this point. So we are seeing that people are walking away from these sectors with very high exposure to China, and that includes retail, includes department stores, cosmetics, for example. We're talking about, for example, Shiseido having about 30% of their revenue from China, and hence it's going to see very big impact if this tension continue to escalate. And China actually, the tourists from China, they account for pretty much the biggest portion of spending when we compare that with other foreign travelers to Japan. So big impact on the travel industry. And now we're also shifting attention to the trading firms, because so far the restrictions, like you mentioned, has been on food, seafood, beef, some of the filmmakers, but also if we're going to expect some more further escalation when it comes to rare earth, that might potentially impact the auto industry for Japan and also the trading firms.
And Winnie, what's the latest thinking around the sell Japan trade? There's this geopolitics in play. There's a focus on big tech, of course. There's also concern around the fiscal story in Japan and what that's really going to deliver. How does all that add up to positioning around Japanese assets?
Yeah, that seems to be the mainstream thinking right now, unfortunately, because we are seeing what we call right now a triple dip. It is the sell-off in stocks after that Takaichi trade, and also now the yen as weak as 155 level against the dollar, and some further sell-off when it comes to the JGBs. So we had that 20-year auction for the JGBs today, and the demand wasn't particularly strong, and hence we're still seeing yields remain quite elevated. And really, this goes to show how investors are still concerned about Takaichi's fiscal expansion policy. And we're also very closely watching what her first economic plan is going to be expected later this week.
All right, Bloomberg's Winnie Sue walking us through the developments there. We thank you so much. Really boiling down some of the details that we're hearing from both the Chinese and the Japanese side. We thank you so much. In the meantime, I want to bring you a quick stock check because, of course, there is some deal news here, some potential deal news that is moving the markets. Very volatile here. You are seeing UniCredit, at least according to an Italian newspaper, Stampa, saying that it may consider BPER Banca, which I guess I'm hoping I'm pronouncing this right, as a potential target. We know Andrea Orcel is, of course, on a little bit of a shopping spree when it comes to the domestic Italian banking unit. He hasn't been able to get the stamp of approval from a series of some of his other bids. Nevertheless, it is moving the market. You did see UniCredit shares down about 1.4%, and BPER, wherever the bank Banca was higher at 1.4% at one point in the session. It's now only higher by 0.2%.
Andrea Orcel seemed to doing all that is possible for one person to do to create capital markets union and banking union. But we will wait to see how that one develops. Coming up on the programme, we'll get back to the big tech focus of the day. Investors look ahead to Nvidia numbers. Q3 earnings will test sentiment at the heart of the AI boom. We'll talk to Richard Windsor next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's cash equity session here in Europe, and it is looking like a pretty mixed picture, and obviously we're not going anywhere fast. Eurostock 600 is flat to the downside. Some underperformance in the CAC 40, but really not a lot of read-through here. We are pretty mixed when it comes to S&P futures as well. The market is really struggling for direction on risk sentiment after a few pretty deep days in the red for the S&P 500. Kriti?
Yeah, it's fascinating. It feels like everyone's just kind of in wait-and-see mode until we get those Nvidia earnings. You kind of see that with the volume that we're seeing right now. On 20-day average, down about 27%, just rounding up there when it comes to the volume picture. People waiting on the sidelines, waiting for some direction. That being said, from a member breakdown, we're seeing more members in the green than in the red right now. That's kind of interesting. 310 versus 265. Let's go through some of the names that we are seeing. Roche continues to be one of the leaders. We saw this in yesterday's session. We are seeing it again today. Yesterday, the talk was all about a new drug that they had launched that would reach an endpoint, really getting rewarded by the market. Feels like a little bit of a carry-on trade into today. Siemens Energy also moving, but I think the one that we were all trying to do a little bit of detective work on this morning was Shell. The idea of the energy complex as a whole higher by quite a bit. What are they responding to, though, as you start to see the commodity space as a whole drop in today's session? Those shares higher by 0.8%. Let's talk about the decliners, though, because this is where the heavyweights really matter, Anna. ASML is the key one here. The tech story, if we're waiting for the Nvidia read-through, even the panic of the last couple of days. ASML is where it's going to show up. Already some nerves there, down about 0.6%. One eye firmly on the banking sector. Of course, we have some M&A news, but right now HSBC seems to be one of your biggest laggards, down by about 0.6%. LVMH, if you're worried about China, if you're worried about the consumer read-through, even if you're worried about the geopolitics, it's going to be a read-through into the luxury giant. Those shares, Anna, down by about 0.7%.
Let's get an update, Kriti, on some of the other stories that we need to keep across this morning. UK inflation fell for the first time in 7 months. The latest print comes as a sign that price pressures are past their peak, ahead of crucial decisions by the Bank of England and the budgets released by the Chancellor of the Exchequer, Rachel Reeves. The US Senate is moving to clear a House-passed bill forcing the Justice Department to release its Jeffrey Epstein files. The House approved the measure 427-1, signaling strong bipartisan support despite President Trump's earlier opposition. Trump, though, has since relented. He could still delay the release of some documents as he orders new investigations into Epstein's ties to Democrats. And the world's most valuable company, Nvidia, is set to deliver a quarterly report later today. The results could assure Wall Street that the AI computing boom continues or fuel fears that the tech industry is in a bubble which is about to burst. Val, which way will it fall?
Which way will we fall? And perhaps will it set the tone for how the equity market broadly trades into year end? For more, we're now joined by Richard Windsor, the founder of research firm Radio Free Mobile, for some thoughts on the wider tech trade. Just 13 hours to go until this Nvidia release. Are you thinking that they could raise the bar further for what is this AI trade into year end?
I don't think they're going to raise the bar, but I think most importantly of all, they're not going to lower it either. And the reason for that is actually very simple, is Nvidia still has more demand than it can handle, which basically means that its revenues are determined by how much capacity it's reserved at its manufacturing partner, TSMC. And as a result of that, I think that's given it very, very good visibility. So what I would expect is they'll very slightly beat the guidance they gave. They will guide very little bit more, just a little bit more in terms of what the expectations are, and that will basically set the tone. So I think the tone basically is going to be, it's not booming further, but we haven't seen a collapse yet.
Well, there's been a lot of discussion in what's driven this recent drawdown in the NASDAQ. We had yesterday Nvidia again for a second day in a row being the worst drag on the index. It was down near 3%. We were just speaking to the Schroeder CIO, Patrick Brenner, and he was really tying this to more of a liquidity story. The fact that we've had a hawkish Federal Reserve, hawkish Fed members really putting that December rate cut in doubt. How are you explaining the recent weakness in tech, and maybe that can inform what you think the market needs for it to bounce from here?
Well, I think there's an element of doubt over a rate cut in December that obviously affects the higher beta end of the market. But I think what is key here is look at what's been going on in the debt market. Now, a lot of these technology companies have raised a lot of debt against the AI build out, and we've seen a lot of pressure on those bonds in the last couple of weeks. And that nervousness really is around, is the business model of spending billions and billions of money on compute, is it a viable model? And so consequently, how viable is it? And that affects the risk attached to the bonds, and also, of course, the risk attached to the equities that are selling these services in the market.
Richard, talk to us a little bit about, I mean, you kind of hit it there briefly in the bond story. I want to take a little bit of a zoom out away from Nvidia and just talk about the tech sector broadly. As we do see this weakness in the NASDAQ, there's also plenty of announcements about lending, innovation, the circular theme that you're seeing from some of the hyperscalers into the innovators, into the AI kind of creators as well. And then throw in there the banks that are, of course, lending billions of dollars to everybody. Is that circularity the new norm when it comes to the tech sector? Is this something that should be raising some eyebrows?
It should raise eyebrows, yes, but it is not the same type of circularity that we saw in the internet bubble that caused the communications equipment sector to collapse when the traffic didn't materialize. At that time, it was much simpler, which was the equipment companies borrowed money, lent it to the operators who spent it back on equipment. And then consequently, when demand fell off a cliff, they couldn't pay back the debt, and you know the rest. This time, it is circular, but it's not circular. It's circular in a more complicated way. What I think that does is it doesn't set up the kind of same potential for a collapse. But what it does do is, if there is a perturbation in demand, what happens is these companies are all now linked to each other, and it will set off a round of sort of dominoes all hitting each other, which will cause, I don't think it's a collapse. I've described it in my research as an orderly reallocation of capital. And I think that is what is on the cards, not really the kind of panic, head for the exits, massive collapse that we saw perhaps when we saw the internet bubble 25 years ago.
OK, so we'll watch that. Yeah, circularity has certainly been one area of concern for the broader market around tech, Richard. Another has been the rate at which you depreciate some of the key technology that's being installed right now, and Nvidia chips are part of that. Are we expecting, can we get some more detail on the useful life of Nvidia chips today that could help us understand over what period it is right to depreciate this technology?
This is a great question. And to be honest with you, you can play, as a company, you can play all sorts of tricks in terms of what rate do I decide to depreciate my assets. There's a simple fix for this as an investor, which is forget about depreciation, forget about profit, just look at the cash flow. And that will fix all of these, basically all of this issue. Now, on the negative side, people say, oh, you know, they're pushing out the depreciation schedule to flatter the profitability. On the other side of it is Google rightly says, hey, we've had some TPUs that are 7 years old that are sitting in our data centers and they're still running flat out because we're so short on capacity. So there is no good answer to that question. From an investor point of view, I would say forget about it, just look at the cash flow.
OK, so cash flow remains the focus then, certainly when we get to the hyperscalers and hearing more from them. Richard, in related tech news, and I wonder how your thoughts develop on this, and it's linked to Nvidia because it's all about where data centers are geographically, within which national boundaries. We had an interesting story yesterday about SAP keeping Microsoft's EU cloud running if President Trump orders some kind of shutdown, tries to cut Europe off from some of its tech provision. I wonder, software nationalism, is this a theme for 2026? We're going to have to watch this further.
I think there's an element of that, of course. To be honest with you, I haven't looked at that story in much detail, but I think by far the most important story to look at in that area is going to be software and technology nationalism as it relates to China and the United States, because basically what is happening is there is an ideological struggle going on between these two parts of the world, and it's being played out in the technology sector. And so consequently, you know, from my perspective, this is a much, much more important place to look, because that is a real struggle rather than perhaps, you know, what might be seen a bit of tit for tat and arguments going on between what are supposed to be allies.
Richard, in the last 24 hours, among the fears and the backdrop of kind of these jitters that you're seeing in the tech space, we also got news of a minor outage when it came to Cloudflare and some of its partners. You had ChatGPT, you had X, you had a series of other platforms that were affected by the outage. And it feels like we've seen several of those incidents throughout the year from Cloudflare and some of its peers as well, including one from Microsoft. It feels like it's pushing this extra tailwind into investing in things like infrastructure. But if you do that, if the hyperscalers that are viewed as growth companies invest in infrastructure and data centers in their CapEx, shouldn't that show up in their valuations? Shouldn't that they be trading more alike, or at least closer to the Chevrons and Exxons and BPs of the world that are also investing in CapEx and industrialization? I know that's a little bit of a stretch, but Richard, I hope you understand my point. What do you think?
I understand your point completely. Which is, you know, if you're one of these neo clouds and you build a ton of data centers, and then you then sell the compute almost as if it's like basically like a commodity, and you are going to see that happen. Now, the thing to bear in mind is that, taking your analogy to its logical conclusion, if you look at OpenAI, if you look at Google, as two examples of this. They're much more vertically integrated. So in your analogy, yes, they would be selling the energy, but they would also be selling the vehicles and the services that are based on that energy. They're much more vertically integrated. So you have to look at it with a little bit more nuance than that, because they are much more integrated across the whole of the AI supply chain.
Richard, thank you very much. Thank you for your time. Richard Windsor, founder and owner of Radio Free Mobile. A busy day for tech ahead, for sure. Let's pivot to other news flow this morning. The US plans to greenlight the first sales of advanced artificial intelligence chips to the Saudi Arabian AI firm Humane. This amid a landmark meeting between the Saudi Crown Prince Mohammed bin Salman and the US President Donald Trump in Washington. Joining us now, Bloomberg's Stuart Livingston-Wallace with some takeaways from this meeting and the developments in this relationship. Stuart, great to see you. So talk us through this broad AI agreement between Riyadh and Washington. What does it entail?
Yeah, good morning, Anna. So, I mean, look, the short of it is we don't know exactly yet. It hasn't been announced, and we don't quite know what the contours are. But what you can say is that this is a big win for MBS and for Saudi Arabia more generally. You've seen this huge push into AI, a sort of a pivot away from some of these so-called giga projects that they've been doing across the country, and really a huge focus and a huge amount of money going into this new company, Humane. And really their idea or their ambition is to be sort of the number 3 power in AI and compute in the world within several years. But of course they can't do that without access to these high-end chips. So the fact that we're even at this stage where it looks like we're going to get some sort of at least preliminary agreement suggests that that will definitely allow them to go forward on that grand plan.
Stuart, there were previously some fears that these chips could get into the hands of China via the Middle East. Have those kind of fears been abated?
Yeah, I mean, I think to some extent we probably wouldn't be at this sort of preliminary stage. So Humane itself has said quite explicitly that it will not be using any Chinese equipment, within the company. And then presumably it will have to offer some other reassurances as well, because that, like a lot of its neighbours, it has to come up with some sort of evidence that that's not going to happen. At the same time, the Gulf nations do maintain, and I suspect want to continue to maintain, strong ties with China. But on the other hand, they realise that the tech coming out of the US is probably at the top of the food chain, and that's ultimately what they're going to need if they're going to fulfil these ambitions.
Stuart, I'm so glad you referenced that relationship between the Middle East and China, because part of the conversations happening between the White House and Saudi Crown Prince is around defense and the F-35 jets that have become a very contentious issue. I want to get your take on it, but before, I would just want to play you some sound that we heard from the former Vice President of the United States, Donald Trump's first running mate, Mike Pence, yesterday commenting on the risk of the sales of the F-35 jets to Saudi Arabia. Take a listen.
I have concerns about the sale of F-35s to Saudi Arabia or any nation that could not assure the United States that technology and the great advancements that we've made with the F-35 don't fall into the hands of nations that are hostile to our interests.
Mike Pence, the former Vice President of the United States. Stuart, he went on to very specifically say that the risk you run is those technologies ending up in the hands of Russians, of the Chinese. What did the president have to say when the jet sale to Saudi Arabia came up?
I mean, I think there's basically lots of issues here. I mean, again, we do need to caveat this. We are at a very preliminary stage, and I think, the good example here is at the end of Trump's first term, he agreed to something similar with the UAE, and what are we now, 5-6 years later, we're still waiting for that to get completed. So we're many, many years off this getting done. However, it's not just concerns about the technology potentially falling into other people's hands, particularly, as Mike Pence said, hostile nations, but I think it's also, here about the balance of power in the region. So, these are very serious bits of military kit. They're about $100 million a pop. And the only country in the region that has them at the moment is Israel. And Israel is supposed to have this supremacy in terms of its military abilities. So there will be some concern there about changing the balance of power too much. On the other hand, you've also seen Trump declare Saudi Arabia last night, or at least my last night, as a major non-NATO ally, which again is a sort of it's signalling this attempt to get this rapprochement, at least on the defense and the military side, and bring Saudi Arabia into the fold, with ultimately the goal of Saudi Arabia joining the Abraham Accords and a normalization with Israel. So again, it's part of a much grander strategy. The F-35s will take several years if they happen at all, but it's all pointing in the same direction.
Yes, and President Trump said he got some positive response from Mohammed bin Salman around the Abraham Accords, so we'll watch for any news there. Stuart, thank you very much. Bloomberg Stuart Livingston Wallace with the details of that relationship as it develops. Let's pivot back to what's going on markets right now, and specifically the banking sector within Italy. Kriti, you were talking earlier on about this story. We'd seen some reporting elsewhere in Spanish media about the possibility of UniCredit buying BPER. Well, we've had a pretty clear denial of that by UniCredit, saying there's no active talks regarding M&A on BPER. Rumours on BPER, a deal there, are entirely unsubstantiated.
We'll keep monitoring those shares, of course, and the share price reaction. Both stocks now in the red. Coming up on the program, we'll get the latest on the B20 Business Summit. That is underway in South Africa. Bloomberg's Jennifer Sabasaja joins the program next. This is Bloomberg.
Welcome back. This is the opening trade. Now, the B20 meetings are kicking off today in Johannesburg. That's a business engagement group that runs ahead of South Africa's G20 Summit of leaders. Not all the leaders, though, and that's part of the story. Joining us now from the event is Bloomberg's Jennifer Sabasaja. Good morning to you, Jennifer. Good to see you. So top South African bankers, they were pretty bullish at the Bloomberg Africa Business Summit yesterday. So what are we expecting from the B20 today? A similar bullish mood?
That's right, Anna. And it wasn't just South African bankers. I mean, it was really Pan-African financial experts, analysts, bankers, CEOs that were quite bullish on the growth trajectory of a lot of emerging markets, and in particular, a number of African markets, in particular South Africa, which we're standing here in today. And as you were just mentioning, yes, today is the first day of the B20, which runs ahead of the G20, and it's really the culmination of a year of engagement and dialogue on some of the issues that have been carried on prior to South Africa taking over the presidency, and seeing ways in which they can push it forward. And a lot of the business engagement, they try to hone in on the fact that they are not trying to rewrite the rules here. They're trying to come together and find some consensus in pushing forward some of the narratives and some of the ways in which they can help strengthen the financial architecture for the Global South, but also for a number of the countries that make up the G20. And so we are waiting to hear some of these business leaders continue to speak throughout the day here. Of course, the elephant in the room is that the U.S. president will not be in attendance, but still, many people are encouraged by the engagement that they've seen over the past year with business leaders and with also some of the other delegates that have been a part of the negotiation. So whether or not we actually get a communique, a declaration at the end of this summit, for some people, it doesn't necessarily matter. The fact that they're all speaking to a certain extent, at least on a business and private sector level, is a win for many of the people we've spoken with.
Jen, you mentioned the U.S. president is one of those notable names missing from the G20 later this week. But what are the views of the ground about the upcoming summit?
Right. Well, the big question leading into this is really, will this summit still be of significance without President Trump being in attendance? Of course, we know there are a few other heads of state that won't be here, but there are still a number of leaders that are planning to come. A lot of quite a few European leaders who plan to also be here. And the question will be whether or not we actually see a declaration at the end of the summit. We haven't yet had a G20 where there hasn't been a consensus. And the U.S. has said they may veto any sort of declaration, potentially only seeing a chairman's statement or agreeing to a chairman's statement at the end of this. They, of course, take over the G20 next year. And so we're really trying to see where some of these leaders that will be in attendance do find consensus. And for South Africa, which is the host of the G20, for the most part, they're dismissing the fact that President Trump is not here and just hoping that they can walk away with some of the priorities that they took over this presidency with and continue to push them forward moving ahead.
All right, Bloomberg, Jennifer Sabasaja at the B20 Summit in Johannesburg. We thank you so much. Let's go from Johannesburg to Singapore, where Bloomberg's New Economy Forum has also kicked off, bringing together key players from government and private enterprise from across the globe. Our very own Francine Lacqua is there on the ground. Fran, we were just speaking to Jen about the highlights in Johannesburg. Give us the highlights in Singapore.
Thank you so much, Kriti. Look, there's quite a lot going on here in Singapore when you have ministers, heads of states, and of course, some of the biggest names in business. What do they talk about? What they worry for 2026? That's AI, that's of course geopolitics and fragmentation. And then there was a lot of talk about de-dollarization, what it means for investments in the future. And we had some pretty heavy hitters talking about how they see the future. Now, I would pick out 3 to 4 big business leaders that we spoke to. Mark Rowan of Apollo actually saying that he does not agree with Jamie Dimon's concerns about hidden cockroaches in credit markets. He basically said that, look, there's a very confusing landscape for investing right now, given interest rates, geopolitical uncertainties, and given prices in general, i.e. inflation, but that he still sees quite a lot of opportunities and he doesn't see anything systemic. Then there was, again, a bit of pushback for Jenny Johnson when it came to the de-dollarization trade. And then I had a great conversation with the president of Goldman Sachs. Of course, he is John Waldron. Now, what he talked about was, look, inflation will stay sticky. U.S. companies are likely to see layoffs in 2026. And then we talked about the more immediate concern of a market correction. And again, he says it's not too bad to let a bit of steam off, but nothing too worried. Here he is.
I think that the dynamic between the U.S. and China, which we call increasing strategic interdependence. So the countries are interdependent, but there are going to be areas where they're going to be more focused on national security. And because that relationship is getting much more complicated, you're seeing more fragmentation around the world. And so a lot of the conversation here in Singapore this week has been about fragmentation, new regional alliances, redesigning supply chains. You know, I worry about that because it's a new world order. And we don't really know what to expect in that new world order. And I think that will create disruption and pressure in the system, which is, you know, kind of unprecedented for the system that we've operated under for quite a long time.
So, Anna, we discussed, of course, this new world order, what it means for cross-border mergers. So lays into more opportunities.
Francine, thank you. Bloomberg's Francine Lacqua from the New Economy Forum in Singapore. Of course, she'll be back in the next hour with more interviews from that event in Singapore. You can see all of those on your screen there. The Swiss Economic Secretary, the PwC Global Chair amongst them. We've just got a red headline around the Dutch and the status of Nexperia. Handing back control to the Chinese is the latest there. This is Bloomberg.